Thank you very much for organizing this event and for this panel. I'm very happy to welcome the three speakers that will address this topic about asset owners. So we had this huge overview about the global challenges and what we need to change worldwide, but I think there is still a lot to do in Switzerland, and I'm happy to welcome Olivier Ginguené of Banque Pictet Asset Management, CIO. Welcome Frank Juliano, also from Head of Asset Management, compenswiss. Please join us. And Mr. René Weber, Head of Policy Coordination, State Secretariat for International Finance. Thank you for joining, and please have a seat. Bonjour. Great. Thank you so much. So all together, we will try now to answer this question. In some way, our asset owners will be this driving force to make sustainable finance or sustainable capital here in Switzerland. So I will be very happy, first of all, to listen to you, your first impression about this question related to your own experience and related to your own organization. And later on, we will ask the public one or two questions and go on with a general debate. So first of all, I will ask Olivier Ginguené. Thank you for joining us. So you are head of Pictet Asset Management, and you are also serving some large institutional asset owners. So how do you see the change related to their demand and to the behavior and the request of these asset owners in this field in Switzerland?
Good afternoon. So first of all, thank you, Angela, and the organization for inviting us to express ourselves about ESG matters. Yes, we are managing portfolios. We are basically managing the assets of final owners. So we act as an intermediary between, of course, the final owners and the market. So we cannot do good by ourselves if neither the client or the market is rewarded it. Now, that said, I have to say that there is an increasing interest for ESG matters, and it's not a linear trend. It's very digital, and we have seen a sort of gap, a breakthrough, more or less 2 years ago. So in the preceding 10 years, we spoke a lot, but essentially for a limited number of interlocutors. These interlocutors being on the extreme side of willing to be ESG and sustainable for the sake of it. And all the others, 90%, basically debating whether there is a materiality or not, whether it makes performance or not. And in the past 2 years, we have seen, at least in my organization, a very radical shift when integration is very much the word of today. 90% of the asset owners and 90% of the PMs, portfolio managers in my organization, are practicing integration. Integration means you are not an ayatollah of ESG policies, but you take that into account and you include ESG matters into the investment process. What we have seen also is an expansion not only to equity, which equity was the common field for ESG policies since 15 years, and very little was in fixed income actually, which is an irony because the risk of ESG is essentially a fixed income risk. This is a risk of going bankrupt. And very recently as well, we have seen a very growing interest in the credit space. Maybe it's because most investors are looking for yield and paying more attention to credit, but ESG integration has also entered very vitally into the credit space and all the process of assessing the credit risk of companies. Of course, this is still much more on corporate than sovereign. Assessing ESG criteria for governments is still, one, very difficult, and secondly, politically very risky. So this is probably the latest stage of this journey. And between asset owners, you have the convinced and the unconvinced. Convinced, they can be convinced about the global effect of sustainability, whether it creates growth by itself, but growth for everybody, for the owner, but for everybody. Another conviction is whether it creates alpha. So whether being ESG makes you better than the competition. And the others are more interested into the downside risk, the risk of extreme events, a Volkswagen case, for example. And the rest is essentially waiting for regulation for moving into this path.
So a huge trend, a lot getting more interest and now action. About this very convinced and just being more reactive and fear of regulation, what is the percentage in your view? Do they all understand what they're doing by this integration, or is it more a movement because everybody's going in that direction?
In the institutional space, at least I'm sure the AVS will confirm, they are very aware about what they do, and just to prove it by one anecdotal evidence, Mercer, which is probably the most influential consultant in the world today for asset management industry, for providing mandates to people like us, ESG policy and ESG inclusion in the process of investment is just mandatory. If you don't have something to say about ESG, which matters, of course, you are just excluded from the RFP. So it's not sufficient, but this is absolutely necessary.
Okay, that's a major switch. Thank you for this introduction. So, Franck Juliano, thank you to be here. So you represent compenswiss, and in fact, you are managing a huge amount, and it's our first pillar here in the Swiss pension system. And you're facing, I would say, a lot of challenge today, because about the low interest rate, because of the need of keeping this capital. So in your view, what is it, this sustainability making your life more easier or more difficult? And probably your opinion on how do you manage to get this element in your investment process?
Well, first of all, good afternoon, everyone, and thank you very much to Swiss Sustainable Finance to invite me. We are probably not the best in class, but we try to improve. Reason why I'm here. The interest rate environment is obviously a challenge for the overall pension fund world, and this is particularly true also for us, for the first pillar. Maybe a few words on it, because maybe not everybody is Swiss here. compenswiss is actually a buffer fund, a reserve fund, and we are responsible for managing the reserves for 3 social schemes. The most important one is the old age and survivors insurance, but we have as well the disability insurance and the specific regime for maternity leave and military service compensation. As I said, we are not a pension fund. The schemes are pay-as-you-go, which means the contribution of the year are meant to pay the pensions of the year, and the reserve is managed like a buffer fund. This has implication also because we face obviously the same issues or the same adverse demographic developments. We face the same lack of financial returns as pension funds do. And for us, it means that we are a shrinking buffer fund. And as such, we need to have quite a conservative strategic asset allocation that includes a lot of nominal assets, namely fixed income investments. This is the reason why the low interest rate environment is a challenge for us. The second reason is that by law we must ensure payments of the pensions anytime. And this is written in the law. This is law 108, Article 108 of Law AVS: security, liquidity, and market consistent return, which is not obvious to fulfill all at the same time. But liquidity means that we must have a very high liquidity profile, and that's an additional challenge for us, because basically we are somewhat limited in what we can do in terms of, let's say, alternative / less liquid investments. And also we must have a lot of cash to fulfill the pension payments. We have a cyclicity of the treasury, which is intra-month and intra-year. I don't give you all the details, but just to planter le décor.
Major touch.
So to answer your question, I mean, is sustainable investing a hurdle for us? I mean, not at all. Actually, for us, I mean, integration of ESG is clearly meant to mitigate the risks, and especially the long-term risks. Now, is it an opportunity? Well, let me speak on behalf of the pension fund world, generally speaking. When you are in a low interest rate environment like this, you have to be creative to find out a differentiated source of returns, i.e. low correlation with equities and with interest rates. And there, I think probably from a pure financial perspective, some ESG approaches, and in particular thematic investing, can be very interesting in terms of risk return perspective, but as well as from diversification benefits. Now, the caveat for us is that we have a tiny portion that can be dedicated to that, and this has not been a priority for us in terms of sustainable investing. We'll be focusing more on engagement and on other ESG approaches rather than those thematic investments. Some of them, we look at them, some of them are basically too illiquid for us.
Yeah, what is the space that will be given in your practice for this kind of more high-level, more strongly impact investments? So is it very small? Is it about 1%? Is it? Do you have more?
There is. I mean, there's been until some years ago there was nothing. Basically,
nothing. Okay, so
but not a lot. I mean, in terms of less liquid investment, I speak about real estate. Yes. I speak about everything.
Okay.
And in 2012, we made several workshops with the board of trustees, and they agreed that in spite of the fact that the buffer fund has a limited life now, because basically it's a shrinking buffer fund and everything else being equal, the fund is going to be extinguished in 2031, 2032. We are hopeful that reforms will come up, but we cannot anticipate institutional decisions, which means we have to manage accordingly. But in spite of this bounded time horizon, the board of trustees acknowledged that we can, to a certain extent, manage some less liquid investments.
Less liquid, okay.
So some priority has been put on real estate, on indirect real estate. It's not even direct real estate, and now maybe some room for further investments.
But globally, you feel comfortable, and you think it make part of your activity now to integrate this factor. It's not anymore yes or no. It's really about going on and improving in that direction, if I listen to you.
I mean, to me, you have to make the assessment. I mean, not doing the assessment is just, because you just close the eyes on something that can just blow up to your face. Doing your assessment and then go for what is appropriate. What is appropriate to the scheme in terms of ALM? What is appropriate to the structure of the fund, of your investment beliefs? Because the investment, we represent the Swiss population. So believe me or not, it's not easy to find out investment belief that suit the overall Swiss population, and so on and so forth, and the time horizon. Because then we know that some of these ESG factors are materializing over the long term. And what about the short-term tolerance? So a lot of questions. There's no one-size-fits-all solution, and we try to find other ways in the middle.
Thank you. We'll get more in detail later on the discussion. Happy to introduce our latest speakers. So, Mr. Weber, so you are representing SIF, this State Secretariat for International Finance, and you are becoming more active on supporting this sustainability in finance. Can you tell us why this motivation, why are you interested in that, and how do you perceive Switzerland positioning itself in this field of sustainable finance? Thank you.
Thank you. Well, allow me 2 preliminary remarks. Simon's attic is a very hard act to follow. I like to see him as the Al Gore of digital sustainable finance. Second remark, for a representative of the finance ministry, this is one of the rare opportunities or rare occasions that I actually get to talk about opportunities and not defensive measures or things that we've run into reputational risks and things like that. So this is also the spirit in which already in 2016 we have introduced a chapter on sustainable finance into the government, the Swiss government's financial market strategy. Sustainability is not a traditional topic for financial market policymakers. You've heard that. But it is becoming so very quickly. And Simon has said it is about what rules of the games should be set. There we talk about effectiveness of those rules. We talk about political acceptance of such rules, and this acceptance is very much national, is very much country specific. Also, secondly, incentives matter just as well, and that's where the price mechanism and price incentives come in. And there we talk about how to approach it, all to gain also the political acceptance that we seek. Our government has clearly acknowledged that the opportunity that is embedded in sustainability and sustainable finance in this new field of activity for the financial sector, that this opportunity should be seized by the financial sector to grow in line with growing demand in this area, and also to gain and maintain competitive advantages relative to other financial centers that are also moving into that direction. In fact, I believe that Switzerland has all the ingredients to actually be successful in this international competition and to maintain, to build on its already existing competitive advantages. Your president has mentioned them, the very traditional ones, high quality in general, quality standards in general, very extensive expertise both in environmental issues and in specialist financial sector know-how. So I'm convinced that the positive message that sustainability brings and also entails can actually help make this field of finance in the future a very important pillar of the financial sector
in Switzerland.
In Switzerland, as other activities are actually shrinking, or as digitalization is triggering structural changes that, for example, has already resulted in a reduction of strong reduction of number of banks, for example, where banks are actually revisiting their business models, where you have the value chain that is disintegrating, and so you have new areas that are now replacing these old activities.
So just for coming back to this opportunity, for you it's about keeping the financial center alive and dynamic, but it's also about what? Attracting new assets under management? Is it, and you said incentives, so nobody is talking about regulation, we'll come out on this point, but if it's not regulation, what about incentive? Is it already?
Well, that's a trade-off that we face in regulation in general. If you regulate too early or too strongly, quickly, you prevent or you stifle innovation. If you do it too late, you might have given rise to abuses or reputational crisis or systemic events. So it's very hard to try and find a balance that also is adequate to the particular business models that are being pursued. Now, as a regulator, or also speaking for our supervisory authority, for example, we don't know better than market players what these future and what these upcoming business models are. So whenever we regulate, we'd like to be a little bit behind, for once, a little bit behind in and actually behind gaining some experience first, see what is going to develop. You don't want to regulate technology, for example, you regulate activities.
Okay.
And that, of course, is a horizontal question. Whoever is providing that activity, can be a bank, can be an insurance company, can be an independent new entity, it can be an upcoming startup.
Yeah, so you need these three-player asset manager, asset owners, and the, I would say, the policy to talk together in order to find out the appropriate regulation to support this dynamic, if I understand you.
If I may, we demand actually demand coming from all areas, from the banks, from the private banking side, where you have a lot of assets being now inherited by the younger generation, from the insurance side, where you have where the risk mitigation and risk management aspect dominates, and from the asset manager side, and also those that produce products that can be sold to clients.
Great. I think we can ask the first question to the public. So, and you will have to answer to this first question, but we will see how the public is reacting and if you agree with the public. So the first question is, this is the link. So if you manage to get this link on your mobile, please do it. And the question, we can see the question or not? It's me to give the question. I gave the question. So the first question, does the concept of fiduciary duty include the consideration of ESG criteria? So for you, the fiduciary duty, does it include the criteria of ESG criteria? You have to answer yes or no. So this is our next question to the three panelists. So we know that long time, financially, fiduciary duty is about risk return, doing the best, and maximization. So in that sense, ESG, should it be included, yes or no? About the asset manager, would you like to start?
Don't wait for the answers. Well, the answer is not.
Sorry? So to keep the link, please, on, yes. Please, Kim, could you please leave the link here? And right. Thank you. So you have time. We have some minutes now to let our panelists give their answer, and we will see the answer of the public. First, yes, no, or you will like answer afterward?
I would say no.
It's not part.
It's not part, because fiduciary duty is directly connected with the necessity of providing the best ratio between return and risk to investors, according to the risk. Of course, for IVS, it's not the same risk as for a young wealth management client. That said, if either the client or the asset manager is convinced that including ESG criteria provide a better ratio, then they apply the policy. And I think this is actually the case for many of them, especially on the governance side. There is a very strong alignment between the fiduciary duty of the asset manager of meeting with companies, making sure the governance is appropriate, making sure the management is doing the right things in the interest of shareholders. And this is very aligned with most of the governance aspect of ESG.
So it's part of the governance, but it's not really part of the fiduciary duty.
I would say no.
No, okay. But that's strange because you said before Mercer today is not selecting anymore any asset manager if they don't do or they don't integrate ESG. So for Mercer, it's a yes.
That's not a contradiction.
It's not a contradiction.
We need Mercer. We need a referee. It could be the regulator. It could be Mercer. It could be you, maybe, to provide a common level field. If ESG is then the common leverage field, then it becomes
Okay,
fiduciary.
very clear. Thank you.
I've taken note of that remark. It's hard to say no. Yes, I would not want to speak for the asset managers, but given that portfolio diversification is a bedrock principle of good investing, I see a case for including a broad range of investments, and of course also such investments that correspond to ESG criteria. In that sense, in my view, there's no contradiction in fulfilling fiduciary duties and sustainable investing. What I do not see as warranted, and maybe that's linked to that, are formal requirements on asset allocation, both as a minimum or as a maximum. And we still do have some of that in our legislation, and we're working on that.
Because the financial government, the Swiss government is thinking about putting ESG in the fiduciary duty. It came out in March, like something like that. So it's more thinking about, but not.
Well,
it's yes, no.
Yes, we are in constant, or we're discussing together with the industry what is best, what can be done in an effective way. So it's part of our ongoing dialogue. Yeah.
Great. Mr. Juliano?
That's not an easy one. The debate around fiduciary duty has been going for years, and the story is not over. And a lot of lawyers, I think, have been tackling the subject with some contradictory conclusions sometimes. The way we see it is that, our duty, our fiduciary duty, is to make sure that we do what is in the best interest of the insured people. You are a pension fund, or you are and for this to happen, I think you have to make your assessment, a thorough assessment on ESG, because so I would put it the other way around. Not doing such an assessment is probably, that's my opinion. A lawyer will say differently. Could be a breach of the fiduciary duty. Then the outcome of the assessment obviously may end up with the conclusion that it's harming the performance, but I would say the fardeau de la preuve somewhat is probably more is coming more and more on our side, and I think it has, and this is the way it has to be. I think whereas I do my assessment, I take into account as I said, the time horizon, because there are some implementations that you cannot afford, because you face potential drawdowns for your insured people, and that's going to be trouble, I can tell you, for the stakeholders, in front of the stakeholders. You have to take into account their values. You have to take into account their and so the interest of the overall stakeholder side. So it's not an easy question, but then you end up with something that is, as I said before, not one size fits all, but it could be a middle road. Right. Something that I know very well, because our stakeholders is the Swiss population, and it's gonna be interesting to see the survey.
Yes, the survey.
See whether, because we have a representation within our board from employers, from employees of the overall Swiss populations, and the debate is
yes.
The debate is not as clear as that one, but
we are in the public of Swiss sustainable finance, so I would admit that there is a certain bias.
It's a bit of a biased assembly.
There is a bias.
Right.
But anyway, I like what you said. It's not about forcing people to integrate, but at least to know, and I think this is what you are doing. It's assessing these elements and to consider this element. Afterwards, you make your decision if yes or not, if it's too risky, but at least you know you have the information. So in that case, it's more about this fiduciary duty to consider it in some way, to assess it. Okay, great. Thank you for answering. I think it's, 80% now, so it's clear. Yeah, I think we can come back on the fact that we presented Oh, I think I've sometimes, yes, right. We presented the results also of the Swiss study, which show quite an impressive increase in this dimension, and it seems to be confirmed by you. Would you say that sustainable investing in some way today, it's really reached its mainstreaming? Are we getting on this large acceptance? Or is it just, again, we are in a trend up and down? Please, go on, yeah.
Speak too much.
No.
Mainstream, I wouldn't say so. Maybe on the institutional side, it starts to become mainstream, at least in Switzerland. Probably much less on the private investor side.
Institutional.
And on the institutional, at least among the biggest institution, I would say yes. The dynamics are quite different, though, because from the institutional world, at least from the big institution, I mean, it's a push towards asset managers to come up to us with suitable investment solutions, suitable approaches, or to index providers. And please, we need this and this and this. And they do that. For private investors, probably it's a bit the other way around, i.e. you, asset managers, play a greater role by coming up with appealing or compelling investment solutions that may attract private investors. It's a sort of, there can be a sort of virtuous circle here. I mean, we push you, and then you propose to your private clients, and you make money out of it as well.
So the trend
you amortize the R&D spending on ESG with private clients, and so on and so forth. And Switzerland is a good place. I mean, from that perspective.
So you see the trend is not yet mainstream, but you think we are continuing that direction. Also, I would say Switzerland, we are losing paths in respect of outside in European dimension, where it's really becoming just a must, which is not the case today in Switzerland because of regulation. But you say the trend is there.
Yeah, and maybe about your role, sustainable finance, it's quite interesting because you put connections between these three worlds by making all these work more visible.
That would be for the conclusion, but yes, happy to hear. Mr. Ginguené, any comment?
I just want to react because implicitly you allude to the fact that managing ESG for institutional could be for free, given that when we make money on private clients on the back of what we do for you. It's not exactly like this. For a more serious reason, the reason is that it's not the same product. I would say that in the institutional space, first governments is more voting, engaging, eventually excluding a few sectors or a few companies is becoming mainstream. If you don't vote, you lose credibility. If you don't engage anyone during the next 2 years, you are not an active shareholder, you are not credible. And so that is becoming mainstream on the institute side. What is becoming more mainstream on the private side, the retail investors side, is more about thematic investments, more connected to climate change, probably, more connected to values, to individual values. So this for us, this is pull and push. We get the mandate from Instit, but we propose a solution to individual investors. And of course, this is about the marketing of ESG. Is the solution that we propose to retail investors, people, like all of us in the street. Does it fit your values, the way you want to invest? And usually, it's less about governance. It's a bit less about social. It's essentially about climate.
Well, mainstreaming, I guess it's mainly an empirical issue, and I'm quite impressed about the figures that the report has produced, the growth as well as the level. We clearly think that this dynamic will continue. It's, as I said, a demand-driven dynamic. I guess mainstreaming, how I would, in my position, would interpret it is that whenever we are in contact with market players, and they tell us, well, this is becoming an integral part of their business model, then that is, I guess, the mainstreaming that we would like to see. On the other hand, mainstreaming also means you need to see the traction. And if I'm quite happy to see the developments, I'm quite happy to see the responses from those market players that we regularly talk to. In a sense, that also gives us some comfort that our policies are more or less going into the right direction.
And supporting this mainstream, but you let the players getting in that direction and supporting with regulation.
That is generally
behind.
part of our approach, that we say, well, it should be a private sector led, and in that sense, sustainable process. We don't want this to be a conjunctural phenomenon only, but we want it to be a kind of a long-term structural change.
Great. Before to come to the climate, because I think this is a topic that came out from this new thematic, and it's quite important. It's been pushed very much also by the the federal environmental dimension. So, just a question: how is ESG or sustainability changing fundamentally the quality of your portfolio? How they're really... Do you see a dramatic change in the holdings in your portfolio, or is it more a marginal one and dialogue? So that will be, I think, for the two that are asset owner and asset manager, fundamentally.
So as I said, this is about integration. First, there is a very common feature now in Switzerland, maybe not only in Switzerland, but at least in Switzerland, is to exclude systematically controversial weapons. This is a very clear trend and clear consensus, at least for Swiss institutional investors, to the point it's almost becoming the standard, including in indexation. So when you replicate an index for an institutional investor, you need not only to match the index, but by excluding some components of the index. So that's not that easy, but that's a request. Secondly, for the rest of the ESG component, yes, it shapes the portfolio in a sense that now every single portfolio manager, be it on credit or on equity, has not only the rating from analyst, the opinion of company visits, but it has directly on his desk all the items about ESG criteria. So if he's willing to buy a bottom 10 company with poor governance, or he knows the risk.
Okay.
He assumes the risk, and every quarter the management, so nasty people like me, are challenging him every quarter. Are you really sure that this is at your expense?
Okay.
So it's not a strict obligation, but there is a very gentle pressure.
Okay, interesting. Julie?
Yeah, definitely agree with Olivier as far as controversial weapons are concerned. It has become almost a standard. We've been implementing that a long time ago already. Now to the question, I mean, have the portfolio really changed? I mean, I would be tempted to say, thanks God, not so much, which means that at the end of the day, most of the companies are behaving in a responsible fashion. Sure, I mean, there are still, I mean, on the margin. On the margin, there are tilts, there are themes. It's true that there are a lot of companies that must improve, and engagement is there. I mean, to help going into the right direction. And obviously, you still have some small bunch of bad guys out there where there is no hope. I mean, you try, and these guys are just systematically and severely violating fundamental rights or laws. I mean, and you just must exclude them. But this is really a minority. So at the end, yes, at the margin, if you apply best in class, obviously you will see some tilts in the portfolio. But is it really a revolution as far as the portfolio construction is concerned? I would see it more as an evolution.
An evolution.
Yeah.
Great. So we come to the second question, and I will ask so the public to answer, to come back to the same place. Yeah, thank you to show it. And it's about climate change. So we will have this last topic about climate change. What will be the main, It's not. No, it's not about climate. Sorry, I'm not. So, what will be the main driver for mainstreaming sustainable investing in Switzerland? So, is it about demand from institutional investor, further supply of sophisticated ESG product and services, public pressure, so from media and stakeholder, or regulation? They have just one choice, or one choice only? What is for you the main drivers? And so we will let the reaction of the public, but I would like to come back to the question of, in fact, climate change. So then, so we will discuss about it, and I think this is also a trigger. This has been an element quite important in Switzerland for asset owners. This logic of signatory of climate and how the investor can intervene or in this field. So what is your opinion about this question of climate change as such? So it's more the E part.
Oh, what I can tell you is what we have started to do. We are maybe not so early in as far as that subject is concerned. We are currently assessing whether or not to treat the climate change as a separate topic compared to ESG.
Yes.
And up to now, it's true that we are addressing some of these climate change issues through our environmental engagement. But this is a bit en filigrane, we say in French. Now we have, for us, Switzerland has ratified the Paris Agreement. And this is important because we try to express as much as possible. I mean, first pillar, the willingness of the Swiss population, and normally this is expressed through the laws, the constitution, and the international treaties that Switzerland ratifies. Which means we think about it. Yeah. We have some plans. Also with so one of the reasons why we were co-founders together with 6 other important institutions in Switzerland of the Swiss Association for Responsible Investment, to pool efforts together, and we have some plans maybe to look at climate change very soon, probably in terms of engagement. Okay. Then we will see if we complement that with some measures on a standalone. Engagement first, better than exclusion. Exclusion is really the last resort, because at the end, I mean, if you engage, if you exclude, you just transfer, the climate risk to another hand. So it's probably not the best solution.
In terms of regulation, what are your expectations for the investor to reach and to support this reduction of risk in climate change?
Well, I would first say that of the 3 factors, of course, the climate element is the one where most work has been done, where most engagement internationally is now currently on the way. Simon Zadek said it, the G20 is active, the large countries, especially also the large emerging markets, see the stake that they have, look at pollution, look at water, other issues that are closely linked to the issue of global warming. We have also on the national level, we have quite a number of initiatives driven by our colleagues from the Office of the Environment. We work closely with them together on voluntary work that has been done to assess portfolios. That kind of exercise, that pilot is going to be continued.
It will be continued.
Yes, they are working on improving the methodology, and now we expect there to be a second round very soon. It is also a topic where personally I see a convergence of interest between those that are rooting for the environment and those that are rooting for the financial sector. So if we like to have some kind of Jamaica coalition or something in Switzerland, that would help
Okay.
support that, we will probably find it. And this being said, the other factors, the non-climate related ones, are also important. What is in general true is that we need good data, we need also transparency, and also we need clear definitions on what we mean when we talk about these things. And there we come to the issue of terminology.
Okay. So before to look at the result, thank you, and I think climate change will be looked more in detail in the next panel. So what is for you, before to find out the results, this between these four elements, the one that will help to support mainstreaming sustainability? So is it demand from institutional, sophisticated ESG's product and services, public pressure, or regulation?
For me, it's public pressure.
Public pressure.
It's you. I mean, the job that I'm doing is to allocate capital the most efficiently. So not randomly, but efficiently to allocate. So to collect the capital from savers and to allocate the most in an appropriate way globally on financial markets. So basically to provide the needs to the one who needs it. And
It's a public.
and I need the support of my clients. It's not my money,
Okay.
sadly. It's yours. So the public, the client, and actually the client behind the institution, because
Yes.
institution, they are not owning the money themselves.
No, it's
They are representing the interest of individuals, of insurance contract,
Okay.
of pensioners, of taxpayers. So I mean, the chief is finally the final order. It's you.
Public. Okay. Us. We are all. And
Well, I would say it's institutional investors combined also with the public
okay.
Pressure that also rests. You mentioned it on the commitment that the public, the authorities have given in this area.
And you. That's.
But I think you've got an easy job in Switzerland because maybe there is no so much need to regulate here, and probably in other countries it would be more the case. I don't know. It's a bit of a philosophical question. I mean, whether forcing people to adopt the ESG integration or having people doing it on a voluntary basis. And
So your answer will be one.
Switzerland is a specific case. I mean, we live in a very wealthy country. I mean, we are above our basic needs, and this means more awareness and more sensitivity to and more responsibility towards ESG issues.
So you.
And look at the penetration of AUM in Switzerland. I mean, there's no regulation, and we are among the highest in the world. And this is
Not yet.
I don't think we are not bad, and I think that the move will accelerate, and the next generation, it's even.
So
because the millennials are clearly by far more sensitive than we are to
So
this.
what would be your answer between the fours?
I don't want to answer to that.
Okay. Okay. So let's
No,
discover.
I think stakeholders. That's my answer,
Stakeholders. So
because-
again,
because
public
at the end,
pressure, stakeholders.
The stakeholders
Okay,
awareness will
most
push.
of you are
will
on
push.
this, right?
Yeah. No, that's.
Can we have the answer of the public? Right. You are totally in line with with the public. So thank you very much. I'm now opening for one or two questions before you have your conclusion and the role. Eric, thank you. Please, I think it's better if you can.
A considerable number of asset owners have gone passive, which begs the question of what do we do with benchmarks, and what should be in or out of conventional benchmarks. So what's your view on that?
You have please. The question is for the three.
Well, I have a very clear view. Today, benchmark are just a mechanistic construction of all participants on the market. So it's market cap weighted and these sort of things. So today we have to customize and then to pay a premium for being ESG, or at least for excluding conventional weapons. I think it should be the opposite. The default choice, the standard benchmark, the standard index used by the industry for asset allocators, for pension funds, for benchmarking retail product should exclude, by default, conventional weapons at least, and probably in the near future should be ESG indices. And eventually, some people can customize and pay for accessing, I mean, all weapons, all the bad things to invest in that are allowed by the law. But the sense of the choice should be reverted.
Thank you very much for asking the question. It's not going to be an easy task. The index providers have understood also that there is something to do here, and they should probably be part of the game as far as ESG is concerned, because it's true that most of the big institutions are managing a lot in passive. We do, I mean, on large caps, basically. We adopted benchmarks that were excluding controversial weapon, and the index providers, globally speaking, I mean, are coming up now with different other sources, ESG or low carbon, and it's quite interesting to see how you can, if you want to have more than one approach, it's going to be a challenge to understand how this is combining together. Now, to your point, I'm a bit divided on whether you should the standard indices should include the ESG components, including the controversial weapon. There was a debate recently with the one share, one vote as well. We've been consulted for a family of indices that I will not mention here. And then it's tricky, because either if you implement them, I mean, there is a bunch of the population of the investors that maybe do not want to carry them. In addition to that, you make the index provider being responsible for deciding, being l'arbitre, actually, for deciding what to exclude, or what to tilt down or what to tilt up. And it's true that this family of indices, I mean, have been growing up in terms of ESG headcount. I mean, it's quite impressive, because they also feel that they have a responsibility there, because it's gonna happen. I mean, maybe not the standard one, but a lot of big institutions will more and more adopt specific ESG indices, and it's very important to have 250 people doing their work properly behind that.
Last question before we close the panel. Okay, I think you have been very clear. Sorry, just thank you.
Pius Kraken from OLZ. Do I have the impression that the institutional investors hiding behind passive investing and benchmarks, and just excluding a few companies, probably doesn't have any effect on the average of the portfolio? Did you already thought about just increasing the level of the average? I think at the moment it's BBB in the MSCI world to maybe A, to get a real effect on the portfolio size. Because if you see the few companies, they have not at all any effects. It's about 0.5%. Even if you exclude all the triple Cs, it's just 2.6% of the whole portfolio. So the effect just, for me, it's just hiding. We cannot do it because the indices doesn't allow it, or it's not liquid anymore. What is your impression?
I guess this one is for me.
Exactly.
Thank you. No, I mean, definitely. I think it's a bit provocative, but probably for some people that could be also a way. I mean, to give the impression to do something, and actually it's true that the tracking error towards the main index is not so much. Now, I mean, regarding exclusion, I mean, our view at compenswiss is that, I mean, this is more a last resort thing. We believe much more in engagement. If you exclude, you just transfer the problem to someone else. And you may miss opportunity, because what's happening is that take high carbon, or take some let's say controversial sectors, people exclude them, fine. Then probably, and they will be probably right in 5, 10 years' time, 2 years' time, I don't know. There will be a turning point where effectively people on the majority will start to disinvest, and you're going to be right. Then once again, I mean, you have to take into account your time horizon. I mean, can you afford the drawdown in the meantime, or the underperformance? Because we have a board of trustees, and there is a force de rappel, which is the traditional index. You know, we are always compared to someone, not only us. I mean, speaking to my peers, with you know, MSCI World and the Limanak. Sorry, it has changed 3 times. The Bloomberg Global Aggregate, the naive combination, and if you underperform over 3 years, they will do what? They will pull the plug. And that's important. We had some initiatives. I mean, in 2001, we implemented a best-in-class approach that was quite concentrated. And guess what? It underperformed. And after 3 years, they pulled the plug. Probably we were a bit early, pioneers in that field. And now the comeback is going to be difficult. We have to document and make the board sensitive to this. So it's true. But it's not us hiding. I mean, it's really I would say a gradual move by keeping the board of trustees on board. That's the way we see it.
I would add two comments. One is about the impact. What do you prefer? To have 1% of the assets owning just the top 50% of the company, or to have 90% of the assets not holding 5% of the bad companies? The impact, if you get a consensus on a very wide set of asset owners, is much more important with a small exclusion than it is to concentrate bets for a very few. So if the question is the impact, exclusion is obviously the first step to follow. That's just, mass versus the speed in physics and inertia. I mean, you need to impact by both the size and the scale. And the second comment is that it's not only because it's about risk of a portfolio. Okay, you exclude 1, 2, 3% of the portfolio, maybe 5, but it depends which 5 you exclude. And I can tell you, if you exclude Enron or more recently Volkswagen of a portfolio, it's less than 1%, but it makes a huge difference in your results. Not to say in fixed income a bankrupt company.
Good. Thank you so much. Just one word. What do you expect from SSF to support this movement? And that would be the word of the conclusion words, but very shortly.
I mean, to me, you are paramount partners. I mean, in that field, because first of all, you are not a one-stop shop, a one-stop look, a one-stop watch for investors or for people that are interested in sustainable investing, to get to know more about it, to get to be guided as well. There is it's still a young industry, and it's a jungle, which means we
guidance will be something you expect and you appreciate.
And the reports you do as well, show, what the evolution, the dynamic of it, and can incentivize, making it more visible and incentivizing smaller pension funds and private investors to follow the.
Thank you, Mr. Juliano. Mr. Weber?
Well, I'll just start by saying there are 2 things that we don't have in Switzerland. The first is we don't have kind of a high-profile action plan as the EU has. So the master plan of all the forces coming together and trying to work towards certain goals, not really there yet. Secondly, we also have not a unified industry position. So the industry is it's diverse. It's also not unified in what goals, what priority they're giving to the issue, although the direction, if you've heard it, is probably correct. So I guess Swiss Sustainable Finance can play a role in both ways, both as our key partner when we try to mediate and bring all these players together, and secondly, to contribute to an industry consensus that would help us to know our path forward.
To define. Okay. And last, thank you, Mr. Weber.
So I agree, it's setting a consensus first. And secondly, I think the idea of doing that in Switzerland, we can raise a concept of neutrality, because if it's a US organization, of course they have a problem with oil and sometimes with weapons. If it's a French organization, they have an issue with the oil industry,
with energy,
with nuclear, with energy.
Yeah.
If it's in Japan, they maybe have an issue, all other issues.
Yes.
Most of the key players are biased. And I would say that
Okay.
Swiss is one of the very few countries which has very little bias in this conversation.
Good.
So there is an idea about the neutrality, giving a fair assessment, a neutral assessment.
Good. Oh, thank you. So I'm very happy. Thank you very much for your contribution. Thank you to the panel also to have participated. And I wish you good coffee time. Great. Thank you.